And to the markets now. A positive day on the ASX. Bond market jitters in the US didn't affect the wider markets here, with the ASX posting a decent rise. NAB came out of a trading halt after announcing that capital raising. It was the only one of the big four banks in the red today. Qantas soared to levels not seen in more than 7 years. Telstra and the big miners were also up. And fund manager Roger Montgomery is with me live in the studio now. Roger, can we talk banks first? I just said we've seen NAB go for this capital raising. Do you think the others will follow suit? And what does this all mean for bank shareholders? There's so many of them.
Well, game theory says that the reason they've gone first is because we know they're the worst performing of the banks in terms of business performance, so they would need to go first. That tells you that the pressure is on all of the banks. Now, Mike Smith has come out a couple of weeks ago and said, we're not going to raise capital unless we absolutely have to. I think this is a signal that they do have to, and now it'll be a game about who goes next, because the person...
But even ANZ, because he also talked about being pretty lean and mean, didn't he?
Yes, absolutely. But unfortunately, this is a freight train that's heading towards the banks, and we've already seen that. What's going to happen? A couple of things. They're going to have to raise capital, or they can use their dividend reinvestment plans to a certain degree, depending on how much time that they've got. But also their mortgage risk weighting ratios are going to change, and that means that they're going to have more capital for every dollar that they lend out, and that's going to bring down their leverage. So that means either more capital, which lowers the return on equity, or less lending, which lowers their return on equity. So the banks right now are over-earning, and that's got serious implications for retirees who are looking for income.
All right, well, let's look at shares versus bonds, because, you know, the current investing wisdom really says you shouldn't park everything in your shares. You should be putting a little bit on the bond side as well. But as I just mentioned earlier, there are a lot of jitters in the bond markets at the moment.
Australian 10-year bonds rose from 2.23% to 2.95% in the space of 4 days last week, and that tells you that they're not a hedge for equity holders. And if you think about the risks for retirees, they're in the worst possible predicament, because they're getting no income on their cash. So they've turned to property, they own their own home, they've leveraged to buy a property, and all of their super is sitting in bank shares which are exposed to property. So what's happened is these low rates have forced everyone into assets, and we're seeing pockets of bubble behaviour everywhere, and as a result they're at the most risk of suffering from another downturn.
But very hard to stick everything under the bed, Roger. I mean, I know you're a promoter of holding cash at the moment, but with everything sort of going up around you, albeit in a bumpy way.
Well, here's the interesting thing. People have migrated out of cash into banks because the banks have a yield that's, say, 2% better than money in the bank. But they've just lost 14% since the peak. So they've wiped out, you know, a good 7 years of the additional benefit from that yield just in the space of a month or so. So really, the 3% in a cash term deposit is a darn sight better than minus 14 or minus 20%.
How risky is it out there generally? I mean, we've talked a little bit about bank shares, but with other stocks?
We're seeing pockets of unbridled enthusiasm all over the place. So record auction price for art was set at $179 million for a Picasso.
Beautiful.
Yes, it was, but maybe not 179 million worth of beautiful. And we're seeing that in collectible cars. We're seeing auctions in Australia in property and elsewhere. We're seeing that pocket of enthusiasm pick up, and that tells me that we're in the mature phase of the boom for the stock market, and it's really time to be cautious. And I know low rates hurt, but they won't hurt as much as losing capital, because it's going to take a lot longer to recover.
And as you say, right at the sort of peak of all this investing boom, we've got a budget tonight.
Yes.
What do you think that's going to do to business
confidence? Well, unfortunately, I think what we need, we won't get. And what we need is we need the market to be given free rein to decide where to allocate capital. And to do that, you need to give tax holidays to startups. It's going to be some years before we see that, because unfortunately a 3-year election cycle doesn't allow the government to see the benefits of its labours, and as a result we won't see that tonight.
All right, tax startups, no, but something else for startups we hope.
I hope so too.
Thank you very much for joining us.
Pleasure.